Welcome back, everybody. Today we're taking a deep dive into the world of tech startups, and more specifically, how to spot the most promising investment opportunities out there. You know, those companies that start small, but have the potential to become the next Amazon or Google.
What's so fascinating about tech startups is that sheer potential for growth. But let's be real, it's also a high-risk, high-reward landscape. So that's why we're unpacking an episode of Margin World today, which is all about giving you the tools to navigate this exciting world.
I love that. Giving us the tools.
Yeah.
Because it is exciting, but it can also feel overwhelming if you're just starting out.
Yeah.
So before we get into the nitty-gritty of investments, can we break down what exactly defines a tech startup?
Absolutely. The Margin World episode defines them as companies in their early stages that are using new technologies or innovative business models to disrupt industries. They're not just creating a slightly better version of something that already exists, they're fundamentally changing the way things are done.
So it's not just about having a cool app idea. It's about using tech to solve a problem or create a whole new market.
Exactly. Think about companies using AI to automate tasks, or fintech startups revolutionizing how we handle money. The source specifically highlighted those two sectors as hotbeds of innovation right now.
Okay, AI and fintech are on my radar now.
Yeah.
What specifically makes them such attractive investment opportunities?
Well, with AI, the demand is exploding across almost every industry imaginable, from self-driving cars to personalized medicine. The potential applications are mind-boggling. And for investors, that translates into the possibility of huge returns.
But isn't AI also a really crowded space?
Yeah.
How do you even begin to pick the winners?
That's where things get interesting. The source emphasizes that it's not just about the technology itself, but the team behind it. They had this great quote, "Investors invest in the founder, not the product."
Whoa, that's powerful. So even if the tech is groundbreaking, a weak team could sink the whole ship.
Absolutely. The source argues that a strong, passionate, and adaptable team can make or break a startup. Think about visionary leaders like Elon Musk or Steve Jobs. Their drive and vision were just as crucial to their success as the products they created.
Okay, I'm starting to see how the people behind the product are just as important as the product itself. What should investors look for when evaluating a startup team?
The source suggests looking at their experience in the specific sector they're targeting. Have they had successes in the past? Do they have a well-rounded skill set, covering everything from technical expertise to marketing savvy? And maybe even more importantly, can they adapt and pivot when faced with challenges?
Adaptability. That makes sense, especially in the fast-paced world of tech.
Exactly. Markets change quickly. And the ability to adjust to feedback and even shift gears entirely can be the difference between a fleeting success and a lasting impact.
All right, so we've got the sectors to watch and the importance of a strong team. But what about the actual investment process? How does funding work for these startups?
The world of startup funding can seem a bit intimidating, but it's actually pretty logical once you understand the different stages. It usually starts with pre-seed or seed funding, where investors, often called angel investors, provide the initial capital to get the idea off the ground. This is the riskiest stage, but also where the potential returns are the highest.
So it's like betting on a promising racehorse before it's even proven itself on the track.
That's a great analogy. If that horse turns out to be a champion, those early investors are handsomely rewarded.
Makes sense. And then as the company grows and proves its concept, the funding rounds get bigger.
Exactly. Series A and Series B funding typically come when the startup has a more developed product, and maybe even some early customers. At this stage, the company's valuation is higher, and the risk for investors decreases because there's more evidence of success.
Okay, so as the risk goes down, do the potential returns also decrease?
That's generally the case. Later stage investments, like Series C or D funding, often come from large venture capital firms and are used for things like expanding operations or preparing for an IPO. These are typically safer bets, but the potential for explosive growth might be more limited.
This is starting to make a lot more sense. Now, you mentioned valuation a couple of times. What exactly does that mean in the context of startups?
Valuation essentially represents what the company is currently worth, and it directly impacts your potential return on investment. A high valuation might seem appealing, but it can actually make it more difficult for the startup to raise additional funds later on.
Why is that?
Think of it like this. If a company is valued too highly early on, future investors might be hesitant because the potential for growth, and therefore their return on investment, could be limited. It's all about finding a balance between a company's current valuation and its future growth potential.
I see. So it's not just about chasing the highest valuation, but rather understanding how it aligns with the company's trajectory.
You got it. Now, another crucial factor the source highlighted is intellectual property, or IP. This is especially important in tech, where owning something unique and valuable can give a startup a serious competitive edge.
Like a groundbreaking algorithm or a one-of-a-kind software platform.
Exactly. These assets can be protected through patents and other forms of IP rights, essentially giving the startup a secret weapon that no one else can legally use.
So, in fields like pharmaceuticals or AI, where innovation is key, strong IP protection is crucial.
Absolutely. But what if a startup doesn't have groundbreaking IP? Can they still compete?
That's a great question. I'm curious about that myself.
Well, sometimes the advantage comes from being the first to market with a solution, what's called first mover advantage. Think about the companies that pioneered ride-sharing or food delivery platforms. They didn't necessarily have unique patents, but they recognized a gap in the market and capitalized on it before anyone else.
So it's all about speed and execution in those cases, being able to capture market share before the competition catches on.
Precisely. But the source makes it clear that just being first isn't enough. They need to execute their plan effectively, scale their operations quickly, and constantly innovate to stay ahead of the curve.
That makes sense. It's like winning a race, but then having to keep running to stay in first place.
Exactly. Now, another factor that can heavily influence a startup's journey is the regulatory environment. Regulations can sometimes create hurdles, especially in industries like fintech, where compliance with financial laws is paramount.
So those are the potential downsides of regulations.
Yeah.
But can they also be beneficial to startups?
Absolutely. In sectors like clean technology, government support in the form of grants, subsidies, or favorable regulations can be a huge boost for startups. It really depends on the specific industry and how the regulatory landscape is structured.
I'm starting to see how important it is to consider all these different angles when evaluating a potential investment. We've covered the hot sectors, the importance of the team, funding stages, valuation, intellectual property, and now regulations.
Okay.
But there's one more crucial piece of the puzzle, right? Exit strategies.
You're absolutely right. It's essential to think about how you'll eventually realize your returns on a startup investment. The Margin World episode outlines the three main exit strategies: going public through an IPO, getting acquired by a larger company, or generating enough revenue to allow shareholders to exit.
Let's break those down. First up, the IPO.
Yeah.
That's the dream for a lot of startups,
Right.
to go public and have their shares traded on the stock market.
Exactly. IPOs can be incredibly lucrative for both the company and its investors, but they're also inherently risky. There's no guarantee the share price will go up after the IPO, and the market can be volatile.
So it's a high-stakes gamble with the potential for a big payoff, but also the possibility of things not going as planned.
That's a good way to put it. Now, the second exit strategy, acquisition,
Hmm.
is very common in the tech world. This is where a larger company buys the startup, often to gain access to its technology, talent, or market share. Acquisitions can provide investors with a solid return, and they can happen at any stage of a startup's journey.
So it's like a shortcut to success, in a way. Being acquired by a company with more resources can really accelerate growth.
Absolutely. It can be a win-win for both sides. The startup gets the backing of a larger company, and the acquiring company gains access to innovative technology or a talented team.
And what about the third exit strategy? Generating enough revenue for shareholders to exit.
This strategy often involves things like share buybacks or dividend payouts to investors. It's generally considered a less glamorous exit compared to an IPO or acquisition, but it can still be quite profitable.
So it's a more gradual and stable approach,
Right.
allowing investors to cash out over time as the company grows and generates profits.
Exactly. It's a less dramatic exit, but it can provide a steady and reliable return on investment.
This has been incredibly helpful in understanding the different ways investors can see a return on their startup investments. But beyond all these factors, the Margin World episode also touched on something that I think is often overlooked: timing. What did they have to say about that?
They emphasize that market timing is absolutely crucial in any investment, but especially in the world of startups. Technologies evolve rapidly, and market trends can shift quickly. Investing when a market is on the rise can lead to phenomenal returns. But investing in a technology that's already peaked can be risky.
Can you give me an example of what you mean?
Think about the early days of e-commerce or the rise of social media. Investors who recognized those trends early and backed the companies riding those waves saw massive returns. But those who hesitated or invested too late might have missed out on those opportunities.
So it's not just about finding a great company, but also about understanding where the market is headed and getting it at the right time.
Exactly. It's about recognizing those waves of innovation and riding them to success. And that brings us to another key takeaway from the source: the power of networking and building connections.
I was hoping we'd get to that. I've always heard that networking is crucial in the startup world.
It absolutely is. Experienced angel investors and venture capitalists rely heavily on their networks to stay ahead of the curve. They connect with founders, other investors, and industry experts to gain insights and identify promising opportunities.
So it's not just about crunching numbers and analyzing market trends, it's also about tapping into that collective wisdom and learning from those who are already in the trenches.
You got it. Especially if you're new to startup investing. Joining investment networks or seeking mentorship from seasoned investors can be invaluable. They can provide real-world insights and guidance that you won't find in any textbook.
This is great advice. It sounds like building relationships is just as important as analyzing balance sheets and market trends. Now, the Margin World episode also briefly mentioned the global expansion of startup hubs. What's happening there?
That's right. While Silicon Valley remains a prominent player in the startup ecosystem, we're seeing a shift toward a more globalized landscape. Tech hubs are emerging all over the world, from Tel Aviv to Berlin, Beijing to Bangalore. Each region has its own unique strengths, regulatory environment, and growth drivers, leading to a diverse range of startup opportunities.
So it's not just about looking in your own backyard anymore. There are exciting opportunities emerging all around the world.
Absolutely. Exploring global opportunities can be incredibly rewarding. It allows you to diversify your investment portfolio and tap into unique trends and innovations happening in different parts of the world.
This is so exciting. It feels like the world of tech startups is brimming with possibilities, but it's also a complex landscape that requires careful navigation. We've covered a lot of ground today. What are some of the key takeaways for our listeners who are eager to explore this world?
I think the biggest takeaway is that investing in tech startups can be incredibly rewarding, but it demands a balanced and informed approach. You have to go in with a clear understanding of both the high growth potential and the inherent risks involved. It's not about throwing money at the next shiny new app. It's about careful due diligence.
So it's about doing your homework, not just chasing hype.
Exactly. You want to focus on industries that have strong growth potential. Carefully analyze both the startup team and the product itself. Consider valuations very carefully. And be aware of any regulatory factors that could impact the company's trajectory.
And of course, timing is everything. Riding those waves of innovation at the right moment.
Precisely. Now, as we wrap up our deep dive into the world of tech startups, is there a final thought you'd like to leave our listener with? Something to ponder as they continue to explore this dynamic landscape. What's particularly exciting about this space is that it's constantly evolving. New technologies and trends are always emerging. I'd encourage our listener to think about what excites them most? What emerging trends or technologies really capture their imagination? And where might they look to find startups working in those areas? Remember, the next big thing could be just around the corner.
That's such a great point. It's all about staying curious and keeping an eye out for those emerging opportunities. This has been a fantastic deep dive. I feel like I've gone from feeling a little overwhelmed by the world of tech startups to having a much clearer understanding of what to look for and how to approach it strategically.
I'm glad to hear that.
Thanks for joining us on this journey into the exciting world of tech startups. Until next time, keep exploring and happy investing.